The simple reality is that the spread of performance between the S&P and the rest of the world, Europe and Asia, is as wide as it's been in the last 20 years. If the goal here is to buy low, it seems to me that the area that's done very poorly is the rest of the world relative to the S&P.
So, Samantha, you take a slightly different point of view there, at least in terms of your weightings. You're a little more overweight in the U.S. than the rest of the world. That's one. But your fat pitch, you believe, are, because of where we are in the cycle, small cap value. They have not been the big players.
They have not. So we think, given stronger growth, a stronger dollar, rising rates, and firming inflation, value does tend to outperform growth when you look back historically. And we can argue this cycle's been different, but this is the economic environment we're in right now. We think value's poised to start to pick back up versus growth.
But if that's the case, isn't the opportunity for value buys right now in emerging markets? And how do you factor in value versus risk?
Right. So it's going to definitely be an international story we'd want to look at. We're focusing on the U.S. right now, though, only because we want to have a bit of a quality bias. And we think given trade tensions and trade worries, the way that's played out is the spread that Andrew alluded to. U.S. market's doing better, and we don't think that that discontinues itself. We think the U.S. continues to outperform international, even though fundamentals abroad do look good. Growth is strong. We just think the trade worries weigh on international
And small cap value tends to be which sectors mostly?
So it's going to partially be financials,
right? Yeah.
And there's going to be a consumer element to it as well.